Welcome back to the deep dive. Okay, we're digging into your source material today, and our mission is pretty clear. We need to unpack what was a really volatile week in the markets
Yeah, definitely a bumpy ride.
and find out where the real strength might be building, under the surface. And crucially, get you ready for this monster week of earnings coming up.
It really felt like a tug of war, didn't it? Early on, things got jolted. Midweek, Wednesday specifically, those old trade war fears popped up again and, well, knocked things back quite a bit.
Right. And we saw some profit taking too.
We did. In areas that had really run, like gold stocks, and even a bit of a breather, interestingly, in some of those AI names that have been leading everything.
And the earnings we actually got were all over the place. Netflix took a tumble, missed estimates.
Hmm.
Tesla, classic mixed bag. Earnings beat, but revenues were shy. Caused some confusion. Definitely selling.
Yeah, that Tesla report was tricky. But look, all of this just sets the stage, because next week, it's all about the Magnificent Seven.
That's where the real focus is. But, what actually saved the week? What pushed the S&P 500 to a new closing high for the week?
It was that positive catalyst right at the end. October's CPI inflation data. It was reported late, but crucially, it came in softer than expected.
Okay, perfect place to start then. Let's get into segment one, the macro picture. Now, anyone watching the charts saw the market jump on that CPI news, but fundamentally, why? Why does one softer inflation number act like, instant rocket fuel?
Well, it really boils down to how markets value future earnings. If inflation looks like it's cooling off, investors immediately start thinking, okay, maybe the Fed can ease up, maybe lower interest rates sooner than we thought.
Right, the pivot anticipation.
Exactly. And when interest rates potentially drop, those future corporate profits are discounted less heavily. Suddenly, growth stocks, especially tech, look a whole lot more valuable almost overnight. That prospect alone is enough to power a rally.
And we saw that play out instantly. S&P 500, NASDAQ, big gaps up on the news. So technically speaking, what are the charts telling us now? Is this momentum looking like it might stick?
I think we are seeing confirmation, yeah. The Relative Strength Index, the RSI, it's firmly positive now. That suggests growing strength. And really importantly, we got a MACD crossover.
Ah, the black line crossing the red.
That's the one.
Yeah.
It's a classic technical signal that often suggests short-term momentum is picking up speed relative to the longer trend.
Yeah.
So it's not just a random bounce. It feels like the start of a new, possibly sustainable uptrend.
What's also interesting, and you pointed this out from the sources, is that it's not just the huge companies driving this. We need to look at the equal-weighted S&P 500.
Yes, absolutely. That index, where, the Apples and Microsofts don't have such an outsized impact, well, it's getting close to its high from back in late September.
And that's good news.
Because it tells us the market rally is broadening out. It's becoming healthier. We're moving away from just 4 or 5 massive stocks doing all the work. That makes the whole structure much more robust.
Okay, and adding one more macro piece,
Yeah.
the 10-year Treasury yield, it's sitting around, 3.99%, and generally trending down. Why is that lower yield backdrop so important right now?
Well, lower yields are generally good for the whole market, psychologically and financially, but they're especially helpful for sectors that are sensitive to the economy's health.
Like tech.
Like tech, definitely. Small caps, too. Look at the Russell 2000. They've been moving constructively. And other areas tied to economic growth. So you put it together. Slightly softer inflation, lower borrowing costs. That's pretty much the ideal recipe for stocks to move higher.
That sets the big picture nicely. Let's shift into segment 2 now and talk about sector rotation. When the market broadens, leadership often changes. We need to find those new leaders. The source material uses relative strength over 2 months to spot this. Who's stepping up?
All right, using relative strength is great because it cuts through the daily noise and shows you where the bigger money flows are really going. And we're seeing definite strength bubbling up in healthcare. XLV, the sector ETF, is advancing quite nicely.
Healthcare, okay. Usually seen as defensive, but showing some offense now.
Exactly. And another one, maybe a bit surprising, is Utilities XLU.
Utilities, that feels counterintuitive. Aren't they usually pretty slow and just sensitive to interest rates, which are still historically high?
Normally, yes. But this strength is directly tied to the AI build-out. Think about all the new data centers going up.
The power demand.
Massive electricity demand.
Yeah.
Utilities are essentially the infrastructure backbone for AI. And technically, XLU had a very orderly pullback to its 21-day moving average. Textbook set up after a strong move.
Gotcha. I also saw real estate investment trusts, REITs, making a move.
Yeah, REITs had a really nice breakout from a 4-month base. Volume was decent too. Often, that's tied to their quarterly results coming in okay. It's an area for investors maybe looking for yield, wanting to step away from the faster tech names.
Makes sense. And biotechnology, IBB, is that another AI angle?
It absolutely is.
Mm.
Biotech's moving to the forefront. Yes, there's the usual drug pipeline news, but the big kicker now is AI initiatives.
How so?
AI is letting these companies crunch massive data sets, speed up research. It's fundamentally changing how quickly they can potentially bring new treatments forward. It's speeding everything up.
Interesting. Okay, quickly then, the laggards. Gold stocks pulled back.
Yeah, heavy profit taking after they hit new highs. They're
Yeah.
still holding above their 21-day average. Technically okay, but need watching. And basic materials,
Mm.
just sort of languishing. Been weak for, what, 6 weeks now?
Yeah, confirms the focus is more on growth and maybe some defensives, not commodities right now.
Precisely. Which brings us to segment 3, because these AI tailwinds are popping up in some really unexpected places, sometimes even overriding other news.
You mean semiconductors, SOXX. This is where it gets fascinating. That group gapped up into a breakout.
Right.
Despite that news about China's 5-year plan to become less reliant on foreign chips, why did that news hurt them?
It seems the market is saying the underlying demand, driven by AI right now, is just overwhelming those longer-term geopolitical concerns. The earnings power and future expectations are just too strong to ignore, at least for now.
Wow, okay. And staying near tech, but broadening out medical devices, IHI.
Another strong area within healthcare, yeah. Driven by really solid earnings from some big, well-known medical product companies, we saw a high volume gap up there, reinforcing that broadening theme.
But the AI ripple effect you mentioned, the most surprising one might be in industrials. Comfort Systems, ticker FX.
Yeah, this is amazing. FX gapped up 19% one day. Huge volume, bullish, Mansi D crossover. Everything looked great after they reported really strong numbers.
And the reason, not typical industrial demand.
It's the AI data centers again. Comfort Systems does specialized HVAC, electrical contracting, stuff needed to build these massive facilities. They reported a $1 billion backlog.
$1 billion, wow.
Yeah, companies lining up for their services. Shows you the physical build-out for AI is really ramping up. And that news immediately pulled similar stocks higher, like Menkelner, ticker EM.
That FX story is great post-earnings, but the trick is spotting potential moves before they happen. This gets us to pre-earnings signals. How do you read the tea leaves?
Well, you watch analyst actions closely, they can sometimes leak sentiment, but the sources gave us 2 perfect opposing examples.
Okay.
On the negative side, Intuit, software company. An analyst downgrade came out before earnings, and boom, the stock gapped down hard on high volume, showed that fundamental worry can just crush momentum.
And the positive side?
Look for upgrades before the report. That often signals someone thinks things look good. eBay was the example here. It gapped up before its Tuesday report, showed a nice technical setup, positive RSI, MACD crossing over.
Ah, so technical strength plus positive pre-earnings chatter.
Exactly. It's often a sign that positive fundamental news might be leaking out, or at least expected.
Okay, that leads us perfectly into segment 4. Financials. This is a real paradox right now. One part seems to be falling apart, the other is thriving.
Yeah, it's quite the split. The regional banks, KRE ETF, got hit really hard. Why? Reports of bad loan discovery, even fraudulent activity at a couple of specific banks, Zion and W.
Oh, wow. Bringing back those banking collapse fears.
Exactly. It immediately spooked investors, and the selling spread to bigger regionals like Comerica, too.
So why isn't that dragging down the whole financial sector, the XLF?
Because there's a really vibrant bright spot, capital markets activity. The sector's basically split in 2 right now.
Okay.
The big money center banks, the brokers, they benefit from a falling rate environment, and they aren't as reliant on just plain old loan activity and a risk for their income. Think Goldman Sachs. It moved up nicely, like 4.4%, because IPOs, mergers, trading,
Yeah.
that's all humming along.
So capital markets are insulating the big guys from the regional loan problems, for now at least. Are those big bank charts holding up?
They are. Morgan Stanley looks constructive, technically speaking. It's forming the right side of a big base. Bank of America looks resilient too, maybe on the verge of a base breakout, getting help from a positive MACD crossover.
So even within financials, you really have to drill down into the sub-industries.
Absolutely. You can't just paint the whole sector with one brush.
Which brings us finally to segment 5, the main event, magnificent 7 earnings. This is likely what steers the ship for the next few months. Let's quickly run through the key things you need to watch for each, starting with Apple on Thursday.
Okay, Apple. 2 big things. First, AI. Where are they? The market sees them as a bit behind the curve, so any specifics on AI integration, concrete plans, revenue potential, that's huge.
And number two.
Still got to be iPhone sales, especially how they're doing in Asia. That's still the main engine for their results.
Got it. Amazon, also Thursday, their stock's been facing some growth questions.
Yeah, the focus there is almost entirely on the cloud, AWS. Is growth slowing down? Competition from Oracle and others pushing into AI infrastructure is a factor, so watch AWS growth closely.
Anything else for Amazon?
Yeah, also keep an eye on their advertising business. That's been growing fast, and of course the overall retail sales numbers.
Okay. Meta platforms, Facebook, reporting Wednesday, they've spent a fortune on AI and the metaverse.
Right, so for Meta, it's about profitability and payback. We need to see strong ad revenue from Facebook and Instagram, obviously. But the market really wants proof they're starting to monetize that huge AI spending. They've talked a big game. Now investors want to see the returns.
Makes sense. And lastly, Microsoft, also Wednesday. They seem to be firing on all cylinders with cloud.
They are. But continued success depends on embedding AI everywhere. So we'll be looking for adoption numbers for their Copilot product. That's the AI in Office and other services. How fast is it growing?
And anything else from Microsoft?
Also important to track their Asia cloud business performance. Given all the geopolitical stuff we talked about earlier, how that region is doing matters.
Okay, so let's try and wrap this all up. We had a volatile week. CPI gave it a needed lift. The market seems to be broadening out healthily beyond just the mega caps. Leadership is rotating with healthcare, and surprisingly, AI infrastructure plays like industrial stepping up.
Right, like comfort systems.
Exactly. And now, next week, the market's direction really hinges on whether these tech giants, the Mag 7, deliver on the specific fundamental metrics we just discussed to justify their pretty high valuations.
That sums it up perfectly.
Yeah.
And maybe a final thought for you, the listener, to chew on. Our sources really highlighted that contrast, didn't they? Between a negative fundamental signal, like that Intuit downgrade causing a gap down,
Right.
versus a strong technical setup, maybe with some positive whispers like we saw with eBay pre-earnings. So the challenge that stands out is this. How do you effectively balance what you can see on the chart, the technical strength, that mass ED crossover, for instance, with those quieter signals, the fundamental sentiment like analyst actions, to decide if a stock's move actually has legs? Is that momentum really sustainable?
That's an excellent question, and it really gets to the heart of navigating this complex market. We'll certainly be watching those M7 reports very closely next week. Thanks for diving deep with us today.